Inflation data puts the Fed in the spotlight. Welcome to Market Insight. I'm David Pollard. A quarter-point rate cut appears pretty much baked in at the next Fed meeting next week. But this week, on Wednesday, we do get one key piece of data before policymakers make their decision, November CPI. Well, last week, Jerome Powell said that given the strength of the US economy, the Fed could be a little more cautious about the pace of rate cuts. Well, let's get a view from Lydia Boussour, senior economist at EY. Welcome, Lydia. Many thanks for joining us. Economists polled by Reuters are tipping a 0.3% rise in headline CPI in November. Given those comments from Powell, could he at least be expecting a rather stronger reading than that?
Sure. So, looking at the CPI report, we're expecting to see also an increase around 0.3% for both the headline and core inflation prints, and some stickiness in the year-over-year numbers. So we're likely to see headline inflation hovering around 2.7%, and core inflation still at 3.3%. It's been in that 3.2, 3.3% range over the past few months. So, it's going to be a report that is going to confirm that this is a bumpy path, that this inflation path is a bumpy one. We've seen a little bit of stickiness in the numbers over the past few months. So I think, if you pair that at the same time with the cooling we've seen in the labor market, our view is that another 25 basis point rate cut is likely at the December meeting, given that moderation in the inflation trend overall, and also given the cool down in the labor market that we've seen.
And does last week's relatively strong November jobs report, at least in terms of the headline payrolls, does that support the case for a further round of rate cuts?
Yeah, so the jobs report last week was quite interesting. The headline print was strong, and we were anticipating to see that bounce back in payroll employment on the back of the fading of the strike impact, but also the fading of the hurricanes impact. If you dig a little deeper and look at the details of the report, you could actually see that, that slowing trend, that gradual cool down in the labor market. We have the unemployment rate that increased to 4.25%. In November. That's in line with the peak we had reached back in July. You also saw a slowdown in the labor supply, with the participation rate also ticking down, and wages hovering around 4%. I think the picture you got from that report was that the data has remained volatile over the past few months because of those one-off factors, but the trend is still towards a deceleration in job growth and that rebalancing in the labor market.
And how is that playing into the consumer, do you think? And what are you seeing in terms of consumer spending over the last holiday season?
Yeah, so we've seen a fairly strong trajectory when it comes to consumer spending growth. If you look at the latest numbers in the third quarter, we had average growth in consumer spending around 3.5%, which is quite strong. Now, at the same time, we got some monthly data. For the fourth quarter, we got the October numbers. And they showed some moderation in spending heading into the holiday season. We had real spending rising by 0.1% over the months. Now, we're still likely to see solid consumer spending growth in the fourth quarter, but some moderation from that strong pace. And when we look at the holiday season overall, we have a consumer that's still spending, but doing so more cautiously. We have prices that are still high, borrowing costs that are still high. So we're expecting to see a holiday season in terms of shopping in November and December that's going to be, around 3% growth, looking at holiday sales. And that's, down from 4% last year. So in line with that, moderating trend in consumer spending.
So 25 basis points looks pretty likely from the Fed this month, and you're forecasting a total of 100 basis points of cuts next year. Tell us about your outlook for 2025.
Yeah, so in the near term, we have another rate cut in December. I think there is room for the Fed to continue that recalibration in December, and then as we move into 2025, that's where there is a lot more uncertainty when you look at the potential in terms of policy for protectionism and higher tariffs, but also for tighter immigration policy. We see more upside risk to the inflation outlook. So the Fed is going to have to navigate these risks. We also have a Fed that's looking at an economy that's still fairly solid. You mentioned Fed Chair Powell last week highlighting the fact that the economy is still in a good spot, in good shape, and that's allowing the Fed to be a little more cautious with this rate cutting cycle. So our view is that, with an economy still robust, we have productivity growth still strong. So that's, a positive in terms of offsetting some of these inflationary impacts. But we have the potential for, significant inflationary impulse from tariffs. So the Fed is likely to be more cautious. And we have essentially the Fed cutting interest rates at every other meeting next year and proceeding more cautiously as it navigates this risk.
And you argue as well that those tariffs that you're mentioning there, that they could also backfire on US growth as much as on inflation, and not just on trading partners.
Yeah, I mean, when we look at, broadly speaking, when we look at tariffs, we've been stressing the potential stagflationary impact from steep tariffs on the US economy, with the potential for a significant hit to economic growth, but also a significant inflationary impulse on the back of higher costs of imported goods. So it's quite important to keep these dynamics in mind. Now, there is a lot of uncertainty. There are a broad range of scenarios. The latest one was the one where President-elect Trump talked about 25% tariffs on Canada and Mexico and 10% tariffs on China. We've done some modeling, and here we would potentially see, a significant hit to the U.S. economy of, more than 1% in 2025, and also an inflationary impulse in 2025. So those are, important dynamics. At the same time, we also stress that this is a different approach when it comes to trade, where trade policy is going to be more transactional. So really using trade policy and tariff threats as a way to also get some concessions from key trading partners. So that's a trend that's likely to be continuing as we head into 2025.
Okay, Lydia Boussour, Senior Economist at EY, many thanks for sharing your thoughts with us today. And that is Market Insight. You can watch more videos on Reuters.com.